Hello, and welcome to SEG's panel discussion, Expert Private Equity Perspectives on B2B SaaS Investing. I'm Austin Hammer, a senior analyst with SEG on the deal execution team. Today, we have the pleasure of bringing together a group of first-class private equity professionals to further educate the B2B software and SaaS community on the increasing role of private equity in software M&A. You can also visit SEG's website for additional complimentary content and materials. Our format today is a panel discussion. We'll be asking about 15 preset questions of our panelists, which will take us to a quarter till the top of the hour. If you are inclined to do so, we do welcome attendees to post questions, and we'll attempt to answer a few during the Q&A portion towards the end of the webinar. To do so, please submit using the Zoom app with the Q&A button at the bottom of the app. With that, I'd like to ask our panelists and Kris to please turn on your video and make sure you are off mute. It's my pleasure to hand the call off to SEG Vice President, Kris Beible.
Thank you, Austin, and thank you to everyone for joining us today. Throughout 2020, SEG has endeavored to provide valuable data and information to the software community through this challenging period of uncertainty. We assembled today's panel with the hope of providing helpful perspectives to your planning for a more optimal funding or liquidity event down the road. Over the past decade, our panelists, along with their colleagues in the private equity community, have helped to professionalize how software and SaaS companies are measured in their performance, and we're grateful these industry experts have been willing to offer their time and perspectives. If interested in exit or liquidity, our research indicates you have a higher likelihood of being involved in a transaction that includes a private equity investor than not. They really are helping to propel the growth of many great software companies and the industry at large. We as the firm have had the good fortune to recently complete deals with each of today's panelists. Filipovic of Resurgens Technology Partners, Chelsea Stoner of Battery Ventures, Jeremy Holland of the Riverside Company, and Phil Cunningham of Accel-KKR represent some of the most sophisticated and savvy software private equity investors, and also happen to be really great people as well. And with that, I'd like to ask Audie, Chelsea, Jeremy, and Phil to please introduce yourselves in that order, and we'll begin our panel discussion.
Thanks a lot for having me, Kris. Filipovic with Resurgens. So 4 years ago, we were bold enough and just maybe the right amount of delusional enough to think that the world needs another private equity firm. So we've been on a quest. To create a highly specialized firm. So exclusively focused on software, smaller or emerging companies, typically vertical applications, typically companies in niche markets, usually founder-owned. We're a single investment strategy focused on building a pretty concentrated portfolio. So fewer investments, more focused on any given company. And the other bold sort of vision is to depend on and value operators as much as private equity firms value deal guys, which I'm a deal guy by training. So that's our quest, and we're fired up about what we're doing and thankful to where we've gotten, and to even have a seat at a table like this is a really nice progress for us. So thanks for including us.
Thanks, Audie. Chelsea?
Yeah, Kris, Austin, thanks for having me as well. So I'm Chelsea Stoner. I'm a partner with Battery, and we are a multi-stage technology investment firm that's been around for almost 40 years now. We manage roughly $9 billion in capital. We just raised our 13th fund in February, which is a $2 billion pool of capital. And while we have venture roots, we have Battery Ventures right in the name, we really have a broad investment mandate. So it includes all things technology, really across all stages. So we'll do seed deals as well as full majority control, a couple $100 million into a situation. So it just allows us to be pretty flexible. But really coming back to why we're all here today, our core focus is software. We've invested in something north of 450 companies, and which includes about 150 SaaS companies. So I guess I would just say, we're looking probably like all the panelists to invest in the best teams, building category leading companies. And we've been really, really fortunate to work with some of the greatest. My key focus area is application software, including a lot of niche verticals, as Audie mentioned, Companies like WebPT, Brighttree, Avalara, Guidewire, Intact, Marketo, just to give you a few.
Thank you, Chelsea. Jeremy?
Thanks. I'm a partner with the Riverside company. We've been around for 32 years and manage several $1 billion, but that's pretty misleading because we remain focused on the entrepreneurial end of the market. 9 different fund strategies, one for Europe, one for Australia, the rest in North America. Debt, equity, bigger, smaller, control, non-control, you name it. As a result, we're a very active investor, completing 40 to 50 new investments each year. We are very active in vertical B2B SaaS, having completed dozens or scores, I suppose, of investments in that space. Global firm, but based out of Cleveland.
Thanks, Jeremy. And Phil, over to you.
You bet. Phil Cunningham, thanks for having me here today. I'm an operating executive with Accel-KKR, and it's interesting as everybody gives their intros. While there's a lot of private equity firms out there and everybody does things a little different, there are quite a few similarities when you hear the intros of the panelists here. We've been doing this for about 20 years. We are solely focused on software and technology, offering multiple or I guess I should say differentiated ways to partner with founders or management teams, as mentioned before, from a majority through a minority investment. Currently investing out of 4 different funds. And I personally work and focus and lead one of our newest funds, which is what we call our emerging buyout fund, which is focused on the lower middle market for software.
Great. Thank you, Phil. And thank you again to all of our panelists. So why don't we go ahead and jump right into some questions relating to data and metrics that software and SaaS companies should be tracking. And so we'll go to Chelsea with our first question here. So from a benchmarking perspective, it's very well known that retention is an incredibly important metric in evaluating SaaS companies. Is one retention metric in particular, gross, loss, net, logo retention, more important than any other in your mind? And if so, why?
Yeah, I'm interested to hear what the other panelists say on this as well. But as with all metrics, the devil's really in the details. So the context really matters here. I'd say we spend a lot of time really understanding gross and logo retention. I view it as a very good signal for strong product market fit, right? Given growth is the single biggest driver of valuation, clearly, having good retention so that you, have a stable base from which to compound the growth onto really, really does matter, right? And so I'd say, gross and logo, a ton of time on that. We dig into the customer cohorts to understand the product usage. If there is high logo churn, we kind of look at why. It might be, the first kind of 3 to 6 months, either a customer was oversold, so maybe it's a sales problem, not a product market fit problem, or implementation, it failed in implementation. And so we spend a lot of time really kind of peeling back the onion and understanding the churn on a much more granular level, right? And really look for, once a customer is using the product, how long do they stay on, right? Because of course that all matters as we think about, customer lifetime value. We do, of course, look at net retention as well, but it can hide a lot of sins. And so I'd say, kind of building up from the base of logo and gross churn first, and then, oftentimes our investment thesis includes, a route to upsell, whether it's product expansion, services expansion, right, to increase wallet share over time. And so we kind of fundamentally focus on gross and logo, I'd say.
Thanks, Chelsea. So maybe as a follow-up, Phil, same question to you. How would you rank the importance of some of these key retention metrics? And then maybe for those serving the enterprise, as an example, any retention percentages that folks should be shooting for?
Yeah, so before I answer the benchmark, I think I would absolutely agree with what Chelsea just said. The devil's in the details, right? You can, everything we're talking about today, you could look at a number And you could say, well, that's my benchmark, but there's so many things that go into, to these numbers, right?
Yeah.
And so I think that, with only an hour, we're trying to scratch the surface and give you some good things to think about. We think about it the same way that Chelsea just went through it. You start with logo, you're thinking about your gross, you're thinking about your net. Net can hide some things, right? Because it is including your upsell and your downsell and pricing changes and those types of things. I would also, one point I would make, probably about 80% of the metrics we're going to talk about today, one of the most important things, and I think everybody on the panel would agree, is that not only do you need to look at these data points, but we're looking for the trending in these data points, right? And so that's very important to understand, that the data at a point in time is interesting, but what's happened over the last, period of time, whether you want to look at quarters, years, et cetera, is also important. From a benchmark, so your second question was a benchmark of, a net or a gross. Again, think about, let's start with net, even though we started with logo, gross to net. We certainly put a benchmark out there at a 100% or better. Now, what does this mean, right? This means that basically with your churn and then all of the other, upsell, downsell, decreases included, you are maintaining your period over period or year over year revenue. The reason we start at 100 is obviously that if you're below that, then certainly you've got a leak in the bucket, as many people would say, to use that analogy. Now, it doesn't mean that we would walk away from a deal that's less than 100, and doesn't mean that you've got bad retention if you're doing this calculation and it's less than 100, but that's a benchmark that we start with. It's a little harder to give a benchmark on gross, because what we really think about is what's that gap. And this goes back to what Chelsea mentioned, is because there's so many things that you could think about. What's the gap between a gross and net, and why is there a gap? Smaller gap, larger gap, et cetera, because that's going to then determine whether you are, getting a positive retention uplift from price increases, but your logo retention is suffering. So that's how we would look to benchmark both of those typically, Kris.
Thanks, Phil. So why don't we go to Jeremy with our next question? So, the Riverside looks at companies serving a lot of different industries and markets with differing market opportunities. When you look at businesses, is there a minimum or maximum size of the total addressable market that you'll consider when evaluating a potential investment?
It's a good question. We've had a great deal of success with investments that people certainly perceive to be small total addressable markets. Well, as you know, with Hematera, now renamed Invita, that's one example. Another in our portfolio is Arcos. When we were looking at Arcos, we found out after the transaction that other potential buyers quickly dismissed it because they are a human capital management platform for the utility industry. And at the time, they already had 21 of the top 25 utilities. And people scratched their head and said, where do you go from here? And in fact, one third party estimated the total addressable market is something like $50 or $60 million. But to our team's credit, they took a deeper dive into the fact that it had effectively perfect retention historically, which was amazing to see, and how mission critical it was, and much more importantly, the module roadmap to come and the pricing opportunity for those modules, given the very specific ROI sale they were conducting. Then thinking much more broadly, they worked with management to say, okay, so what you're really good at is highly complex, ultra urgent staffing in unionized workforces. What other addressable markets would that same logic apply to? And you quickly come to airline pilots, first responders, several other markets that are very, very large, that have the very similar complexities. And so while other potential investors quickly dismissed it, we were over the moon about it, and remain so today. I guess we're biased given that it's in the portfolio, but it's been a fantastic ride with management, and more to come. So we think that it's valuable to think broadly about total addressable market.
Thanks, Jeremy. And maybe as a follow-up for Audie, There's so many interesting vertically focused businesses serving niche segments. Any additional color on factors that would give you and Resurgens comfort investing in a company with a perceived small TAM?
I mean, Jeremy's answer is perfect in terms of specific examples. Even the first company that he mentioned is a great business that embodies all of this. So I'll rattle off some questions that kind of generalize some of the examples. Is it a valuable segment? So we're talking about a small TAM, however you calculate it. So let's assume it's a small TAM. Is it a valuable segment? Is it worth owning it? Can you really underwrite the company being a leader, not just saying, hey, the leading, but truly the leader in the market? Is it strategic to somebody? Who is it strategic to, right? Are leaders rewarded, not just from a potential acquirer, but even from the other buyers in the market? Yeah, the most positive manifestation, is it worth owning the market? Is it benefit being a leader? You know, something network effects, overused statement in software, but a company that has network effects where it's actually costly for a customer not to become a customer of the company. I mean, that is the holy grail of owning a market, small or large. So yeah, the other thing that are important, you know, is the market stable? Is it growing? Is it shrinking? Is it evolving? Is there M&A amongst your customers? So you're going to be on the right side of M&A? Are you going to be on the wrong side of M&A? Are the profit pools changing in that industry? How likely is it that you'll expand the TAM over time, organically or better yet, inorganically, right? Riverside has done a really nice job with some of the companies that I know, you know, from in a small TAM where they've gone ahead and bought companies nearby. You know, do you have the right customers to start out in the space in terms of being on the right side of the acquisitions? The other thing that's important, I think, is the cost structure, right? In the current the current dynamics of your business. The thing about being in a small TAM, you know, in a small market, you're not going to grow your way out of a cost structure problem. So getting to interesting unit economics earlier in the development of a company is pretty important because there's only so much you can get. So anyways, this is a topic that we're truly consumed by at Resurgens, because we got to be really good at this point of view. We're far from perfecting it, but it's becoming a science, and we're not the only ones that are consumed by figuring this out. So it's a really good question and topic.
Thanks, Adi. So Phil, next question's up for you. So we get a lot of questions around optimizing sales and marketing operations from entrepreneurs. So in preparation for conversations with someone like yourself, what are some of the specific metrics that entrepreneurs should be measuring in their sales and marketing funnel or pipeline?
Mm-hmm. Yeah, so I think we all probably would agree that sales and marketing is usually one of the easier areas of a business to track and trend metrics, because you have quota carriers and marketing spend and, you know, win-loss ratios, et cetera. And we definitely dig into this, you know, quite a bit to really understand how efficient and effective, you know, the sales team is. And it can also lead back to underlying challenges with product, et cetera. Again, these are metrics that you would look to trend, but we dig into bookings by type. And again, we're calling a booking obviously is a sales activity, closing a deal. And by type, we could mean looking at it, annual contracted value versus one time, or it could be by product. We tend to, you know, look at what that trending has been. So we see the right type of trending with the right type of, you know, recurring revenue in a business. Salesforce productivity. This is one where it's really nice to maybe take a look at like your over or under performers and trend that over time, so you can see that you're continuing to focus on more and more of your sales team being over quota. The turnover of a sales team is always a good one. Overall productivity, or what we would call return on a sales rep, is another metric that we like to dig into. And I could go on and on and on, but I actually will finish with probably the three that most of us would agree on, and probably all of us on this call. In fact, Kris, I think you did an entire webinar on some of these, but customer acquisition cost, which there are multiple ways to basically calculate that, but customer acquisition cost is a measurement of your spend versus what it's producing, for bookings or results. And there are some nuances that you look at, year over year or period over period, and whether you include gross margin or not include gross margin in the calculation. But that's an important one. Another very important one just takes that and puts a lifetime value on it. So now you're just entering in your customer acquisition cost calculation, but entering the element of how long or what your retention is. But then the one that I'll spend just 30 more seconds on here, because it's an important one, is you take both of those and you simplify it down into what we would call sales efficiency. So just your new and upsell bookings divided by your total sales and marketing spend. And again, these are all just nuances of this one. So if you do that, you say, okay, my new and upsell bookings, are X, and I'm going to divide that by my total spend, you're going to get a number. And that number is then going to help you understand whether you're in a position to put more fuel in the fire, right? If your number is over 1, let's go, right? If the TAM is there, which Adi and Jeremy just talked about, then we should be thinking about ways to, put more gas and go. If it's under 1, that's probably in a situation where you're going to think about further evaluation. What should you be thinking about as it relates to your go-to-market? And again, so to wrap up, a lot of metrics, but customer acquisition cost, lifetime, and then this sales efficiency, which I'm calling, kind of the easier one to think about, are 3 critical ones that we look at.
Thanks, Phil. I think that's really insightful. So next question, we'll go to Jeremy and then Chelsea. I'll ask the same question. Jeremy, what are the top 2 metrics every entrepreneur should be tracking in their business that you often find they do not?
I'd probably take it back to what Chelsea led off with, which is the why. So as opposed to a specific calculation, it's what they're already calculating, but they're not capturing the context. So when there is churn, as an example, it would be hugely valuable if they would track why they left. It's different if the customer went out of business than if they just chose to go to a cheaper competitor. Or let's say they went to a cheaper competitor, but then they came back 2 years later, which is actually a form of validation that they tried the competitor and it didn't work out, which is yet still again different than if they, the end market has had some turbulence and other types of reasons. So if they took the time to track the why, I think there would be a tremendous amount of insight into the existing metrics.
Yeah, I was going to say the exact same thing. Just churn reason code we find oftentimes it's just not tracked anywhere and sort of lost, and extremely valuable, obviously. I'd say another one that's interesting and oftentimes not tracked on a granular basis is just monthly or quarterly new versus upsell bookings. That is pretty simple stuff to start tracking if you're not, because it's super informative as to what's going on.
Thanks, Jeremy. Thanks, Chelsea. Adi, Phil, I'll ask you another question here. When assessing investment candidates in the context of Rule of 40, do you have a preference for a weighting towards revenue growth or profitability? And let's go to Adi first.
I think Phil is going to actually be more useful resource because they have much better data from a more robust set. I'm starting to frankly be a little bit cynical about Rule of 40. It's anywhere and everywhere, and look, we all like profitability and growth. The only thing better than 8-minute abs is 7-minute abs with same effect. So how about Rule of 41 or 45? The thing about the rule, it's a good rule of thumb. What it doesn't tell you how you should trade one off. It's not really linear. I mean, as a small company, it's got to grow, right? Ideally speaking, you got a 20 and 20, right? So what does that mean? It's 20% growth. If you knew you're going to have 20% growth in perpetuity, that would be wonderful. And already proof point, you got 20% EBITDA margins. And we all like software companies because they scale really nicely and have fixed cost structures. And it doesn't take a lot of convincing that they'll get a lot more profitable if you choose to make them profitable at the right level of scale. So I don't know, I guess to answer the question you asked, between growth and profitability, I think the smaller the company, the more the more one ought to put weight on growth, because ultimately you want to get to a different level of scale for a lot of reasons, based on who's going to acquire the company, as well as to give yourself a chance to be really profitable.
Thanks, Adi. Phil?
Yeah, I think so. That well said. And maybe just to take one step back, I don't know how, there's a lot of folks on here, but the rule of 40, and Kris, maybe you've done this in past webinars, but again, what we're talking about is basically looking at a year-over-year growth or CAGR added to the current EBITDA margin to get to a number which, produces 40. And that's what Adi was talking about when he was saying there's trade-offs. It is talked about a lot, right? So probably everybody on the webinar does know it. I think you nailed it with your answer. It does, and it makes sense, right? If the business is $10 million, right, you're going to probably have a little different perspective on growth than if the business is $100 million, right? Because you're growing over a completely different number. We would tend to look at it, as a rule of thumb, being a little bit more oriented towards growth. But again, it goes back to what Adi just said. That's because of the size of businesses that we are looking at, and especially what I specifically look at for the firm. They're in that more of the 10 to 15 to $20 million size, right? So we would tend to be a little bit growth oriented. But again, as we've said, probably with every one of these, the layers of onion that need to be peeled to get to the real answer on all of these is really where you should be spending your time.
Thanks, Adi. Thanks, Phil. So Jeremy, let's go to you with this next question. What are the top one or two most common reasons you would say no to making an investment in a company?
Beyond churn, the most common for us is that the software was designed to be horizontal. So let's say you're providing a specific service to all small to medium-sized businesses without any specialization. And so they often end up competing on price. We've had tremendously more success in very niche vertical B2B SaaS that's mission critical. Back to the earlier point, even if it's a very small total addressable market to start, it gives them a really great base to work from and radically better retention in our experience.
Thanks, Jeremy. Phil, let's do another follow-up to you here as well.
I think I would agree with that. I mean, we when you think about why would you walk away from a deal, or what would lead you to not do a deal, I think churn, absolutely, right? So retention, mission criticality. Let me just hit on that one because it was mentioned, but that one's a big one, right? Is when a company, when one way to think about it, when your solution goes down, not that we'd ever want to think about that, right? But do you have a mission criticality factor that the business can't operate, right? And that's a good thing, not a good thing to be thinking about like the business going down or your servers going down. But if they need your solution to run the business, and as high as you can get on that mission criticality scale, whatever scale you're using, I think is a very important one for us. And so the lower down that mission criticality, the lower down, an excitement level would be to get a deal done.
Great, thanks, Phil. So next question, we'll go to Chelsea and Adi. And this has to do with the importance of retention or growth in your mind. And so a few years ago, SEG would oftentimes see the highest corollary from a metric standpoint to valuation being revenue growth. But it seems like that's shifted a bit over the past couple of years, and particularly in 2020. If you're just isolating for retention or growth in the context of evaluating companies, what is more important in your mind, retention or growth? And I'll go to Chelsea first.
Yeah, I mean, it follows, kind of the earlier conversation, right? Rule of 40 versus growth versus profitability. I'll tell you, I'll take growth all day long over retention. Just the compounding effect that has, right? So, rule of 40, I'd rather have 40% grower for forever at 0% rate profit. That becomes a really big business pretty quickly. But again, as with all things, the devil really is in the details. I think, over time we've become much more comfortable. We used to not really consider businesses that had less than 90% renewal rates. And now I think we're doing a much better job in really understanding why that is. 80% renewal. I just go back to, if you have 80% renewal rate, you need to be growing really, a lot faster than somebody with 90% renewal rates for it to be interesting. And by the way, you have to have a pretty big TAM to make sure that you can continue to fill that leaky bucket, because it is a leaky bucket with 20% of your business going away every year. But if you just do the math and run it out, the compounding effect of revenue growth is going to get you a bigger business a lot faster.
Thanks, Chelsea. Audie, any additional thoughts there?
No, I mean, it's the devil is in the detail, right? If you're stuck in our world, which is smaller companies, niche markets, the fundamental threshold question is one kind of that Phil was pointing to, mission criticality. You wanna make sure first and foremost that your company is durable. It matters. It has a reason to exist. And somehow a lot of us believe, not somehow, for good reasons, that retention is a good indicator that I have a really good value proposition. I need to exist. Now, I talked about earlier, a small company being small 5 years from now is not a great investment, right? But a small company that has really not a good reason to exist or has trouble finding its reason to exist is a really big problem. I think that as you get into broad markets and you have phenomenal customer acquisition story, I think this is kind of what Chelsea was talking about, growth. Growth is growth, right? And you're not going to run out of TAM, and you keep scaling your sales organization. And back to Phil's point, your sales efficiency metrics are sustained. It's kind of an awesome market with a lot of growth can hide a lot of sins, and so go get it, right? But that's not really possible in a small market, in a niche market. So I don't know.
That's
depends what you're going for.
Yeah, I agree.
Thanks, Audie. So I'd like to ask a few questions related more transaction dynamics, and we'll go to Jeremy with this first question. Is there a typical framework from which entrepreneurs can expect to operate post-transaction?
I think it matters greatly based on their goals and what they're looking to achieve. We often have pulled forward. We'll take a step back. 20 years ago, you'd buy a company, and then post-closing, the first board meeting would literally be okay, now what? And all of that has been pulled forward. So now the due diligence process is formulating that go forward plan, that 100-day plan, what exactly needs to be done, which roles they want us to help fill. Are they asking for our sales excellence team to come in and help them design a comp plan, hire salespeople, whatever that is? We hit the ground running a whole lot faster and get into a kind of a rhythm and a cadence with the Riverside operating partner. The title's a little misleading. They're not in there operating the business, but rather they've walked in that CEO's shoes time and time again, and are going to be that key sounding board from the board level to help management get where they want to go. But eventually you want to get into a kind of a rhythm and reporting cadence. And then we also have a separate group within our operating team called finance directors, and they'll come in and help establish KPIs, reporting metrics, things like that. Many of our entrepreneurs have not ever had a partner before. And in a couple cases where they have debt, they haven't had a lender before, and all that comes with that. And so during that process, we'll bring our team in to help establish that rhythm for them.
Thanks, Jeremy. Next question, we'll go to Audie. So Audie, we commonly have entrepreneurs assessing whether or not they're interested in selling to strategic parties or pursuing a transaction with a potential investor. And so on the topic of an equity roll, why is rolling equity an attractive option for founders and operators? And what should sellers be considering from a deal terms perspective to ensure that their equity is being treated fairly?
Well, so as an academically trained person in portfolio theory, I get the benefit of diversification, and God knows we spend a lot of time convincing founders to transact based on that argument. Diversify, right? You're in a risky asset class, diversified. Having said that, just to be a little blunt here, the private equity, software private equity, the sun is shining on this asset class. The returns have been phenomenal, and there's a reason that there are a lot of people chasing ways to get exposure to this asset class, right? A founder has an inside seat. He's an insider, he or she is an insider into their company and the prospects of that company, right? So, getting exposure to the upside. Furthermore, if you look at, some of the firms that are sitting around the table and others out there have created phenomenal shareholder returns in a fairly predictable manner. So ability to participate that with the right partner to take forward. And then there's the emotional part. I mean, this is the one time you get to have your cake and eat it too, in a way, right? I mean, this is the one chance to kind of go for it, taking a bunch of money off the table, presumably, diversifying, and at the same time, really going for it. I mean, really think about what you're signing up to do as a founder with one of the firms like this in an investment. Presumably, the goal is to create 3 to 4 times as much shareholder value in 3 to 5 years as might have been created in the 20 previous years. I don't know, an average company that Resurgens invests in is 15, 16, 20 years old. It's not 3 years old, right? And so the type of value creation, the type of journey that you're going on is a pretty neat ride. And so, you get the benefit of diversification, but you also kind of get to go forward with your company, with your brand, with your culture, betting on a lot of what you created as a founder. That's the story. As far as protections, I mean, really is that presumably let's say it's a control majority recap. So all of a sudden you go from controlling everything you do as a founder to now being a minority participant in this. There's basically, I guess 3 real concepts is: one, is your rollover security in the same security as the investor? So pari passu, are you in the same class of stock? Are you in the same part of the waterfall? 2, do you have minority protective provisions that I think any reasonable investor would give you the same minority protective provisions, I think. And then 3, the one that's a little more high stakes and a little more philosophical, I think, from firm to firm, is the repurchase, right? Whether or not your majority, your financial sponsor has the right to repurchase your stock. That's a pretty big topic, and that one requires a lot of kind of thinking on both sides.
Thanks, Adi. So next question to Phil, and as a follow-up to that related to equity role, what factors would impact your view of how much you prefer or like to see existing shareholders' role in a transaction?
Yeah, so the first thing that we often say internally is that the question we love to hear from a founder, and again, we're talking about founders in this section predominantly, is how much can I roll versus how much do I have to roll? And I think that then sets the tone of a lot of the things that Adi was just talking about. We don't go into an investment saying we have to have X% of roll with a founder. What we do is we look at all of the other data points, right? We dealing with a situation where this is the founder's first company. They've been at it for 20 or 30 years, and they need to de-risk. They need to do a little bit of the things that Adi was talking about. Need a liquidity event, which we know is obviously important. Size of the business. What other management team, might be rolling along with them? Are there other passive investors that we need to think about? So there's a lot of things that go into the specific number of a roll. But at the end of the day, we would say we'd like it that it's meaningful, right? That this person still operates the business in the same manner that they operated it when they owned 100% of it. It's kind of the easy way qualitatively to think about it.
Great, thanks, Phil. Jeremy, next question to you. If a CEO or really particular key shareholders that are active in the business want to step away or reduce their role after completing a transaction, what factors impact their ability to do so in your mind?
I think it's depth of team, and it's important. It's a really good question, because when they're meeting with potential investors, they should also be thinking about that. it's always somewhat of a head scratcher when you go in and the person says, look, at my advanced age and my health issues, I'm looking to step away as quickly as possible. And then for the next 3 hours, they dominate the conversation. The CFO never gets to speak. The head of sales never gets to speak and whatever. And throughout it, they say, well, I'm not involved in the day-to-day anymore. It's really them, but yet they answer every single question. I'd encourage them or their advisors to coach them to purposely turn those questions over, resist the urge to answer every question, or beyond that, be very open to walking us through what positions need to be filled. If they are wearing 7 hats, what hat they plan to wear for 6 months, what hat they plan to wear for 12 months, and which ones they would like help hiring into immediately post-closing, so that we can get our hands around how are we going to manage this going forward.
Thanks, Jeremy. And Chelsea, next question to you. So what top factor to would cause you as an entrepreneur or an investor to think about exiting sooner rather than later, or I guess expected?
Yeah, this is a tough one because I look back at all of the companies that we have sold to early in this bull market, right? But I think it really comes down to, or has for us at least, a couple things. One, oftentimes founders or teams, after some period of time, get kind of tired, right? And so we're really fundamentally long-term investors. I'm looking at the Braintree decision, which on that journey we had three different times that we could have sold the business, and we just said there's just so much more to do here, guys. Let's just keep going. Again, back to that compounding effect. And then, finally, Dave came to us and said, guys, I think it's time to go. I've been doing this for 12 years. You've been in for 8 years. And we're like, no, it's too early to sell. But, sure enough, when the team tells you that, they're really ready, that's when we listen. And so we take a lot of the cue from the team. I think as we're talking about, maybe smaller niche categories, it is a constant question of how much longer can you continue to grow, right? At nice levels. Because as we know, growth is the number one, predictor of value on the back end. And so, we do look a lot at, maybe in year 4, 5, 6, 7, what's going to be our next few years growth trajectory. And is this a time where, we should be maximizing multiples or not, right? And if multiples are lower, then we just keep on going, because that's the beauty of the SaaS business model.
Great, thank you, Chelsea. So we've got a lot of good questions coming in from the audience, and I want to make sure that we reserve enough time to at least address a few of them. So I've got one more question that I'll ask to each of the panelists. So what excites you about investing in software and SaaS over the next 5 to 10 years? Why don't we go, Jeremy, why don't we lead off with you?
There's just really been no end to how much these entrepreneurs surprise us and where they can go. Back to the earlier point about expanding total addressable market, and it's just been it's been really fascinating seeing how many firms are coming in. There's a very vibrant market. Multiples are great. Knock on wood, no end in sight for entrepreneurs to take advantage of it. It's really important also as a nation. This is a way we're creating a lot of jobs in these business models. This country does not create the heavy industrial metal benders at the rate it used to. And this is a really important driver of our economy. And the more that we can help these entrepreneurs grow is a lot of fun. Creating jobs is core to what private equity does. It's something I'm proud of, and we need to do a better job of getting that out and making sure that both the media and Capitol Hill understands what we do. But it's really exciting. It's a lot of fun to be involved in businesses that quadruple or, better in our window of partnership, 5 years, whatever time that is. it's a lot of fun, really rewarding to see how big these companies get. Not just bigger, but better businesses, lower customer concentration, better stability, multiple end markets served, which of course results in job security for everyone working there. So it's a lot of fun. It's a great segment to be in, and I really don't see it slowing down at all.
Thanks, Jeremy. Phil, how about you?
Yeah, I echo what Jeremy just said. I don't want to be redundant, but I would add on just the amount of fun it is to, work with these businesses. For the most part, everybody on this panel, we are not investing in household names, right? Unless you're in life sciences, you're in, a specific vertical, you never heard of these names. And when we're introduced to them, and I think the thing that excites me is that you haven't heard of the company and you're saying to yourself, wow, interesting, the software technology that focuses on this solution for this vertical niche that you've never heard of before. And then you start digging the materials like, wow, this is great. Somebody has built a business from zero to whatever in this space that most people would not even know exist. And I think that goes back to what Jeremy said. It's just a whole lot of fun to not only learn about these and then to figure out, wow, this could be a great partnership for us, right? And go figure out how to double, triple, quadruple these businesses. I think that's the most exciting thing.
Great, thanks, Phil. Adi, how about you?
Just to pick right up, because not to be redundant, because I believe in everything was just said, the cost to start a business and the barrier to start a business has been doing this, right? So when I said at the beginning, we're consumed as everybody else here is consumed figuring out, what makes a niche business tick, what makes it valuable, how to get scientific about creating an awesome company in a limited market. That's because more and more companies are specializing, right? Again, the cost to start a business has been decreasing where you don't have to be a software guy. You don't have to be in Silicon Valley and have $50 million to create your product. You can have none of that. And next thing you know, you got a really interesting company that really matters to your segment. And that's not changing, which means more companies. So in terms of the supply of companies, it's interesting. From an asset management perspective, as an investor perspective, I mean, what gets us excited at our segment, every time somebody announces the next $1 billion fund focused on, software and technology is great, right? Raise the 2 and the 3 and the 4. It's a very vibrant exit environment. Metal bending industrial companies trying to reinvent themselves, wanting to own vertical software companies, wonderful. Traditional software acquirers, wonderful. General private equity firms wanting a piece of software because it's resilient and has great margins. It's a great exit environment, but it all goes down to one thing. Can you build an awesome business that matters in its industry? Big, small, whatever. A good company is a good company. It will find a great home eventually.
Thanks, Adi. Chelsea, how about you?
Yeah, I mean, I guess the benefit or not so much of going last. I echo all of that. I think it is a super exciting time. We're probably in, I don't know, inning 2 maybe of this transition to cloud, right? It's less than 40% of this $1 trillion software market that has transitioned to cloud. As Adi said, the cost of starting software companies has just plummeted, which is what has created all these really super interesting vertical applications. And so, no, we're super excited. I think this is going to be, another 10, 20 years of good place to be.
Great. Thank you. So let's jump into a few questions here. We'll try to get to one maybe at least a question for each of you. So the first one will go to Phil. So this question came in about our discussing KPIs for sales and marketing efficiency. Do you have any metrics that you would look for as it relates to the efficiency or effectiveness of product and development teams?
Yeah, so we do. So this could be I'll try not to make this a 30-minute answer because we don't have it, because we all know that product could be, in the simplest term, what we try to do with product development, and now think to yourself product roadmap, is to go through a process with our companies where we are looking at, kind of a 5-year, then down to a 3-year, then down to what do we need to do now type of conversation. And then when we get to the what do we need to do now, the metric we are looking at is that for, now not every little bug fix and feature functionality, but the big modules that a business is looking to build, we're going through a business case and we're looking at what do our competitors offer? What are they pricing it at? Why don't we have it? Are we losing deals because of this? And it's more of a business case calculation than it is a metrics that we get down to saying, okay, we've got an ROI on this of X because we believe if we go build this widget, right, we'll penetrate X% of the market every year and gain this much competitive share that give us this type of return. So, and that was maybe a long way through the forest, which I didn't mean it to be, but it really gets down to, is there an ROI or business case around what you're building? So often we find that smaller businesses, they're just building what they think the largest client or the loudest salesperson might want, but it may not be the thing that actually returns, the most profit or revenue to the business.
Great, thanks, Phil. Next question will go to Chelsea. So Chelsea, how much flexibility are investors giving in their assessment of numbers with respect to COVID in 2020? And I guess a follow-up question that I would have to that is, how are you thinking about budgeting for 2021? Are you doing anything differently with respect to the current environment?
Yeah, good question. COVID has definitely put a wrench in a lot of businesses. And on the flip side, frankly, we have seen the increased kind of transition to digitization, also a tailwind for some of our cloud transition stories. Yeah, I mean, look, like all things, we need to dig in, and it's really understanding the historical levels of, I go back to cohorts and usage, and is this a category leader? But I'd say across the board, we just looked at this. Roughly of all of our businesses, roughly 80% had a budget decrease of about 50%, right? And so if they were planning to grow, 5 million in 2020, our budgets have been peeled down to 2.5. And actually, what we found is it hasn't been that dire, which is the good news. And so things, seem to be rebounding. But yeah, I mean, like all things, if you took a COVID hit, a lot of folks did, and we just need to understand the details behind it.
Thanks, Chelsea. Audie, we'll go to you with this next question. How does customer concentration play into how you evaluate potential investments? Is there a maximum percentage that you get comfortable with from any particular customer, or how do you think about concentration?
I think some of my panelists may cringe when I say my positive bias experience. The first investment I was ever involved with had nearly 100% customer concentration, and we made a phenomenal return. I spent eight months of my life during the first financial crisis being consumed by this one entity that we had exposure to, and how we would diversify. And is this clearly, the more customer concentration, the more of a binary like bet you're taking, whether it's a customer concentration with a customer, a channel partner, an ecosystem. I mean, ecosystem investments are phenomenal. You're betting on an ecosystem with Salesforce or Dynamics or what have you. So I don't know. I mean, I have that experience. So I know private equity 101 is diversification, and I get the benefits of it. But I've also kind of had the experience to be trained and to think long and hard about, well, what's behind it and whether or not this is well worth underwriting. So, maybe it's a little bit of a atypical answer, but we've been involved with, 20, 30, 40% customer concentration. It's not like we love it. Contractual protections help, no doubt, right? Is it a real contractual protection, multi-year contracts, non-cancelable, termination for convenience doesn't exist, things like that certainly help. obviously the longevity with the customer and understanding the value prop. So anyways, I mean, we've been, I think, on the more creative side of willing to entertain customer concentration, but there's no doubt that one would love, 3,000 customers and no customer over 2% of revenue. That's wonderful too.
Great, thanks, Adi. And so last question over to you, Jeremy. It looks like we've got a minute left. How has your process around completing deals changed during 2020, and do you expect any major adaptations to stick?
I think a lot of them will stick. We previously spent a huge amount of time on airplanes because we really value the face-to-face interaction. Wish this could be done face-to-face. Look forward to when we can do that again. But just the reality of the situation, we don't get to sit on the sidelines. Our investors has tasked us with deploying this capital. And if you can't do it, they will find someone else who can. And so we had to get creative, and certainly Zoom and similar services have played a big part in that. And what we've often done is do the face-to-face as final confirmatory at the very end of the process, along with customer calls that you waited to the 11th hour on, which was kind of blasphemy a year ago. You'd always want to get out there because we inherently love business. If you like, anyone on this panel loves business and loves to get to know entrepreneurs. But we have to do what's practical and what's safe. And so I think a lot of that's going to stick. And also with our board meetings, a lot of our really high performing portfolio companies, things are firing on all cylinders. We're all flying all over the place all the time for board meetings. I'd be shocked if they go back to being 100% in person. I think there'll be a mix, and it'll be more efficient with everyone's time to do some of those. When you're in year 5, and everybody knows each other well, and you're in your really great rhythm, I think that there's going to be a lot more virtual meetings. But it's what's been amazing is how much it's adapted. We've completed more than 24, maybe 36 investments during the pandemic, and have a full pipeline to go. So it's interesting that we're adapting and powering through.
Well, thank you, Jeremy, and thank you to all of our panelists. And of course, thank you to all of our guests. We hope you found this session to be helpful. We hope everyone remains safe and healthy, and please do let us know if we can be of assistance. I'd now like to turn it over to my colleague, Austin Hammer, for closing comments.
A special thanks again to the panelists. Your experience is invaluable, and we're grateful for your willingness to share your insights. Thank you to the attendees of this event as well. It wouldn't be possible without you guys joining. We'll be sending a form to submit any additional questions in the event that you didn't get a question answered, and we'll do our best to answer those promptly. We'll also make the recording available. Thanks again, and everyone have a wonderful rest of the week.